Good. Good morning. Good morning, all. Seem to be a few chairs missing. Thank you. First of all, thank you very much for joining us. There's more people in this room than chairs, which is always a fantastic outcome. There we are. So, one of our shareholders at our last AGM said to us, you presented at Mello in 2018, you should come back. And in 2018, the slide that I put on the screen at the sort of very end of the presentation gave sort of a bit of an idea of what the group would look like back then. These are half-year numbers, and this was a map of where we were. We had two platforms in a quarried materials group focused on high-quality quarrying assets and companies across North Europe and associated products that we would buy. The quarry would buy the associated downstream products and then integrate those into small platforms and then grow that business slowly but surely. The very interesting sentence at the top of the slide there was sort of our ambition back then. So grow that platform, buy and build, integrate, improve these businesses, hoping to have a European footprint in the next 3 to 5 years. We sort of put a really ambitious number there, 500 million market cap. We were basically nowhere near that number back then, and we thought, okay, well, let's see where we can go from here. If you take the same sort of statistics and you go to where we are now, we've actually managed to get to the numbers and to the size and the scale and the ambition that we set out back in 2018. We went from 2 platforms of activity to 6. We've got 76 sites, 1,800 people, nearly 1.5 billion ton of reserve across the group, an EPS of about 5.5 for last year, trending towards, if you take the brokers' forecast, trending towards the high 6s, maybe 7, which is pretty much twice as much as where we were on full year 2018, nearly 800 million in assets. The strategy of the group is exactly the same today. It's sort of encapsulated in the 4 key pillars: invest, improve, integrate, and innovate, which I'll come to in a minute. If you take the evolution of the group over the last 5 or so years since founding in 2017, sort of a one-slide time frame, we're quite proud of the fact that we got going from a standing start and managed to get to a point here with very significant growth numbers, both in terms of revenue, in terms of EBITDA, but also profitability. Sort of 15 transactions, one after the other, to get to the footprint that we really like to have. What hasn't changed since our 2018 presentation here is our business model and our way of operating. It's sort of encapsulated in these 6 bullet points. What it boils down to is the following. We are a quarried materials group, so we own and operate quarries. That's the key point. Why quarries? Because they're fantastic assets to own. They always generate cash, even in a downturn, because you're effectively selling your asset bit by bit. You will always generate cash, whatever happens. That's one. They're usually well positioned to have as an inflation hedge, both in terms of local duopoly, monopoly type situations in various regions. So you have a lot of pricing power. It's very difficult to open quarries, so your markets are protected. And there's obviously asset value that's there, so that's the second thing. Since the product that comes out of a quarry doesn't travel far, your regional market is well defined, you know exactly who you compete with. You can create network and synergy effects, but on a local level. And that comes there comes the platform logic. Let's bolt together a few companies that have similar features, similar nature, similar product that really can help each other in a region. South Wales, the Midlands, you name it. We then improve those businesses. That's the absolute point. They are typically well run as we buy them, but you can do a lot more with them. Simplifying the operations, simplifying the administration. Very often when we buy a business out of a large group, it's the burden of administration, the burden of reporting, the fact that people are really spending their time in an office and not outside in the operations that makes the difference. It's the commercial positioning of the group, where it sells, how much it sells, at what price it sells. All these things can be improved. And then the cash flow that's generated out of those companies can then be recycled and purchase a next set of businesses and on you go. So that's the 6 points. We usually present that into sort of the 4 boxes here. Invest, improve, integrate. That's the 3 key pillars. And we've added to that now innovate recently. because clearly ESG, clearly product type, all of these things need to be looked at very very seriously now and for the future. So that bracket I'll come back to in a bit. The key feature that we think we add when we buy a business is really the improved part, and that's the growth of EBITDA from a pretty decent company all the way up to what we think is the sort of optimal running rate. We show this graph. It's only till 2020, but it sort of captures really well what we try to do. What it shows you is on a like-for-like previous year full run rate EBITDA basis, what the acquired EBITDA looks like versus what the improved EBITDA looks like. So if you have a company that does 5 million EBITDA, how much extra can we squeeze out of that every time? And what we're particularly proud of is that over the years since we got going, obviously the starting year was a bit higher because it was our first transaction. Every time the amount we spend on acquisition and the amount we extract more out of the businesses bought is fairly similar. And that allows us both to do two things. One, to make sure that when we buy a business, we always try to buy it at earnings enhancing multiples and cost at the start. But we know that we can extract quite a bit of value extra out of it, and that cash can then be recycled to purchase further, and on we go. So this obviously till 2020, we haven't done the graph yet for 21. And obviously a little graph, which obviously I'm sure you're very interested in as well. When we presented here in 2018, our share price was 37.5, and then our strategy really started to resonate with the investor base. I'm very thankful for that, and we managed to go all the way up to 113 before sort of the weakness in terms of inflation and the Ukraine and geopolitical crisis recently. If we look at the operations side of things, it's probably where we get into the sort of the meat of the story here. This is one of our quarries here in the UK. This, by the way, mountains of agricultural lime and limestone, very useful these days when the fertilizer are expensive. The footprint we've got at this point, which is quite a nice one, is our target region. The target region has always been anything that is connected to the Baltic Sea or the North Sea. Why? Because each of these markets are, from a legal perspective, very clean and well structured. Why is that so important? If you can go to the mayor and bribe the mayor to open a new quarry, I don't like to operate in these environments because I do not really know what my market looks like and what my competition looks like. These markets are very strict and very clear on that. When you buy a quarry, you know how many others there are and you know what your market looks like. So that's really good. Lots of growth in Poland, fantastic infrastructure setups, especially in the Nordics. Harsh winters, need to be rebuilt all the time. Big industrial base around there too. The UK, obviously, we all know very well. Benelux, very fantastic market for aggregates and construction materials. 6 platforms at this point in time. The Channel Islands, where we started here, great business, does a great job for us. North Calc, the green area, England and Wales, which is to do with quarries in the UK. The precast products business, very innovative, forward-looking business of finished goods. I'll come back to those in a minute. And then in the Benelux area, 2 companies which effectively started as one purchase, which we split and grew separately, either Dimension Stone on the one hand or standard aggregates and concrete on the other. And that gives us a target region, which is really good for us in terms of setup. We can grow in that region. We can probably double the size of the business again within that same region, so we don't need to go any further. The eagle-eyed among you will have seen the Ukraine here. We have a license on the deposit, the largest limestone deposit in Western Ukraine. It's not running, it doesn't do anything, it's just a license. Hopefully the situation in Ukraine will stabilize at some point in time, and that license may come in very handy then in terms of rebuilding efforts in Ukraine. Going through the platforms in a bit more detail in terms of product, so I've sort of detailed the various ones already. Rhone is a mini Breeden, a mini Lafarge, a mini CRH. It does everything from a driveway to an airfield, you name it, in those 2 islands. It's been a great business for us. We've multiplied the earnings there quite significantly over the last 5 years, and it looks to continue. The Dimension Stone business in Belgium is the largest open cast Dimension Stone quarry in Europe. So that makes cut material for terraces and also for infrastructure. Belgian blue limestone is characteristic for a number of things. Its color, but also unlike the Italian marbles, which are beautiful, its porosity is very low, so you can use it outside, you can use it in swimming pools, it doesn't freeze and then break. And as a result of that, it's also very heavily used in infrastructure. For instance, in Holland, Belgium, North France, city squares, museums, and so on use that. The second business in Belgium is a split out of the acquisition around of CDH in the south. The Benelux market for construction materials is a fantastic place to be. Has to do with the fact that it's very dense in infrastructure in these regions. If you take an aerial sort of NASA view from the north, and you see how many roads you've got in these regions, you'll see that the density, because of the big ports, Rotterdam, Antwerp, and so on, of road and the road network is multiple times higher than, for instance, here, which means that it needs to be maintained and lots of infrastructure requirement for concrete and aggregate. PPG, Precast Products Group, everything that has to do with finished goods, parts of staircases for big buildings, platforms for train stations, barriers to separate traffic in and out of ports, nuclear facilities, comes out of there. Also concrete products which are more basic, flooring systems. We're doing a lot of work here in terms of innovation to make that whole business green. Everything it sells is already low carbon, and that's a complete first in the UK. And it has the potential to grow further into Belgium, into North Europe. England and Wales is fairly new, and that's with the Johnston Quarry Group purchase earlier this year. We're really trying to see if we can get a proper footprint in the UK, but England and Wales really more than Scotland, not so much, but really around this area here of limestone quarries feeding the standard construction market here. And at Nordkalk, an interesting business because it has both standard aggregate and high-grade product, which goes into metals and paper and all the rest, but out of the same setup, the same quarry. It doesn't look any different than a standard quarry you would find. And as a result of this, we are in a position to have a very nicely diversified business from a revenue perspective. Obviously, half is still construction and infrastructure. It's the biggest part. But the other half is high-grade uses of the same product. So if you have limestone out of some of our quarries, you can really decide, I can sell it into a paper mill, into a steel plant, and I get a lot more money for it. And if it doesn't go there, it will go into concrete or roads. Gives it two bites of the cherry, essentially. And it sort of diversifies our revenue mix quite nicely. Market-wise, 5 core markets. Finland looks to be larger. We're the largest supplier of cement stone to all the cement plants. There's really only us that do that, which is a great place to be. So that obviously increases the revenue a little bit. But effectively, you take that out, you've got 5 markets of similar size, with the UK and the Channel Islands probably slightly bigger than the rest. Nice geographic diversification. And in terms of product mix as well, higher grade products here, sort of nearly 40% of the group, quicklime and high grade limestone, higher margin, application in industry primarily, and all the rest is primarily in construction and infrastructure. All this to say that we are nicely diversified around a very compact region of high quality markets, which is always very good. Some financial data, very quick, also from a perspective of when we saw you last. Obviously, all these graphs have gone up quite a bit. In particular, obviously, revenue and underlying EBITDA. This is only half a year of Nordkalk. This will probably be closer to double that for a full year. Consistent every year increase in EPS, even in rough years like 2020. Every year we managed to grow the business from that perspective. Again, with full earnings from Nordkalk through, that should be improving again. And then an interesting fact as well is we keep our leverage constantly around the 2 mark and then trending down. We're quite happy at 2. Our covenants are 3.5. Typically what happens is we generate cash, we create a pool of cash, and then before we actually pay the debt down, we utilize that again to buy another company. So it allows us to continue the growth of the business. Some people then ask, well, are you happy with that amount of debt? What does that mean in the context of your group? The answer to that always is, we have 1.3 billion ton of reserve and resource in this group. We use about 20 million tons a year. So that's a massive asset base. And you can see that in the numbers here. This number probably doesn't actually capture the real value of what that reserve base means. And that asset backing is what gives investors and bankers in particular confidence in the group itself. And obviously personnel, that's grown to about 1,800 now. It's large, but compared to the size and the spread of the group, it's not even that heavy. Now, I mentioned the innovation side of, probably next slide here, the innovation side of the business these days. 4 examples. The first one, green block. So back in 2020, we started to feel that the demand for green concrete products was at some point in time going to properly shift. Everybody always talked about green. Everybody said, yes, it's very important, but nobody would then actually pay for it or want to buy it. Another problem was that there wasn't actually a product out there that would do the same as a standard cement-based product without any negatives in terms of strength, in terms of characteristics, and of production costs. So we did a lot of testing and trialing and designing and R&D in our facilities, and came up with the first low carbon, even zero carbon concrete block. If you use recycled aggregate, you can actually get it quite close to zero. The trick here was that it can be used. We can use the same plant and machines as any standard producer of concrete, but then get a ultra low carbon block out of that. That we launched in 2021. And have now come to the point with further development, everything that we make out of our PPG factory, so you can see some of these retaining walls, these are structural, they're ballistic tested in some cases, can be made out of green or ultra low carbon concrete. That's a first. To give you a bit of a feel for that, there's a business called CCP in the Northwest that we bought in 2019. When we bought it, it made 20 million blocks a year. We've nearly doubled that now. We've switched over one of the 2 factories completely green, so we now make 20 million blocks, green concrete blocks per year for general use in house building, through the merchants, in infrastructure. So that's a really promising product, and it has allowed us to do a JV with Marshalls. Marshalls have said, well, we've got a fantastic R&D facility. They're obviously a great business in the UK with a fantastic footprint. Why don't we work together and see if we can do more in paving and other products that they make? So that's the green block side of things. Zipper, High-Vis, the Nordkalk paint. A few other examples of innovation. Zipper is the traffic management systems into Dover to manage Brexit, essentially. That was 20 kilometers of road barriers that you can move. If you drive down the M20 towards Dover, you can see them on the side. They get moved into the middle of the road from time to time if there's heavy flux in and out. That's a completely innovative system. It's out of the US. We're the sole supplier for that in these territories. We've developed a mobile application for safety, very key. This is effectively democratized safety. Everybody's got it on their phone. If there's an observation to be made on anything that's unsafe, an incident to report, it can be done through the phone in a very intuitive system. It sort of asks you questions, automatically generated, and that hives up all the data straight into our central safety team in real time. So if you have an incident in one place, in real time we'll know about it, and we can start to tell people in other parts of the group, watch out, this could happen, this strap could break because there's a fault in it, that sort of thing. And then Nordkalk, this is just one example of the many innovations they have. There's titanium dioxide, which you use to get these really ultra white paints on buildings. You sometimes see them. Difficult to mine, fairly toxic. We replaced that with super fine, super white limestone. We're completely unique in having that product in the north. And you get the same result, but with a fairly clean, or much more clean product than titanium would be. And all that means that we were quite happy and quite proud to present a ESG roadmap for this year for the whole group, with a net zero point in 2040. A lot of people ask, how do you get there? Is this all sort of wishful thinking and the technology is still to be invented? Unlike cement, the cement makers, obviously a lot big CO2 producers, the lime side of things, which we are in, again also kilns, also CO2 producing, is a much more manageable setup from CO2 capturing and storage than a cement plant. Simply has to do with volumes. Cement plant is several thousand ton a day of CO2. A lime kiln is several hundred ton. So with a containerized setup, you can actually capture that and then use it somewhere else. And that technology already exists. The biofuels that get burnt in these kilns that exist, these kilns can be refitted. So the trajectory from here to there, from our perspective here, is completely feasible with technology we already know about today. So that's on the ESG front. Outlook, slightly different map than last time. This is purely the areas we have actual operations in. We sell into Germany, we sell into France and Holland. But if you see this map, and if the target is to be around the North Sea and Baltic Sea, there's a few places that we can expand into. The Baltic region, we have created that as a separate operating region. These three countries relied a lot on Belarusian and Russian imports. That's all stopped. So we make that a separate entity. They absorb stone from all the other places. Poland keeps being fantastic as growth. There's obviously network effects possible if we start to operate into Germany. The UK is still fairly light. So there's a lot of opportunity for us to still expand and keep growing the group as we've done. Targets that we've set for the next 3 to 5 years. Organic growth top line, 5%. That was every year on year. That's clear. We want EBITDA margins higher than 20. We want to be a high quality business with higher margins. That's part of the trajectory as well. Cash conversion in a group like ours is good, which means that we have £50 million plus of free cash to use, either invest, either pay down debt. That we can decide which one is best. And if we stop acquiring businesses, which obviously bring in inefficiency and lower returns as you acquire them, and we stop and do nothing for a couple of years, the return on capital will trend automatically towards from sort of the 10-ish mark where we are towards the 15 point, which is reassuring, but also good from an investment and a capital discipline perspective. And so that means that from where we stand here today, I was here last time in 18 with a sort of a statement. We hope to get to 500 million market cap and a larger footprint across Europe. In that same footprint, there is much to be done. The business from a setup is fantastic. The assets are extremely high quality. The teams behind it is still as motivated as day one. So we're still going hard and fast after this, and hopefully in the next 3 or 4 years we can come back with a even more impressive map. Thank you for your attention.
Very good.
Thanks very much for that. Do you have a rule of thumb about how exposed you are to GDP?
There's two parts to in terms of answer to that. So GDP, every materials business across the globe is exposed to GDP. So that's logical. What we've always tried in terms of the businesses and geographies we're in is that when you have slowdowns, that you don't get a double impact, which is volume reduction, but also price reduction of your product. Because that's an uphill battle, then that's going to take a while. The volumes typically bounce back fairly quickly. Even within the year, you look at 2008 and 9, you have a drop in aggregate consumption, but in the same year that starts to then recover. If you have on that downward slide, you're also on pricing, your pricing has suffered. That's a 5-year journey. And so we've always gone after niche-like businesses and niche products so that pricing problem isn't there. If you go to our admission document that we published for the Nordkalk deal, you'll find in there a graph of 12 years of Nordkalk's trading, which includes the financial crisis. And you'll see in there that the worst year in terms of EBITDA margins was sort of 12-13%, of highs of 22 or 3. So that tells you that even if it's going is really, really rough, that business is still making decent amount of money. So, and that's exactly the sort of business we want to own. And so the answer to you is GDP, everybody suffers with GDP if it goes down. We hope to be insulated better than others by that.
Does every quarry have its own kiln, or do you transport mined rock to kilns?
Not every quarry has its own kiln. Specific quarries have kilns where the material is suitable for that. We don't tend to transport far, again, because you destroy a lot of value. So what you have to have is a strategic network of kilns in the right places. And so when you look at some of the, not all of them, but the kilns that we operate are typically around coastal areas. So they're here. Well, this one is a bit of an exception, but they're usually around coastal areas. So the quarry is nearby, and it can then be loaded on a ship, and it can then travel a little bit, short distance by sea. Quicklime is probably the only product that does travel by sea properly, because it's 150, 250 pounds a ton, unlike our standard 10 pound a ton rock.
Right. And what's the maximum delivery radius, excluding your Channel Islands business?
Again, good question. That's the whole point of being around the North Sea and the Baltic Sea. These sort of shipping routes for quicklime are sort of run of the mill. So you would supply to the Baltic states from here. But that's pretty much the best you can do. It goes on smaller barges very often, so 5,000 ton type, sort of coaster type vessels. You wouldn't take it further out than that. And so that means that if we have a proper setup for lime and limestone, high grade limestone and lime around here, we're also very much in control of the shipping routes because you get backhauls. You send quick lime one way and you take something else back.
You clearly have a very successful integration formula. Can you actually explain a bit more what you do when you go to a new company?
Yeah, so I just explained exactly what we're doing now with Nordkalk. So typically what we have as a target is 18 to 24 months to get 30% uplift in EBITDA. The first 3 months we do nothing. That's by design. We go, we visit, we say hello, we absolutely do nothing. We just want to see how the business works. We want to understand it properly. Certainly don't want to spook people. Oh well, these guys from London are coming in, and because we want to get buy-in. What we typically do when we're doing that sort of 3-month exploration phase is we sit in quarries. Charlie Trigg is very good at that, with a chronometer, looking at plant machinery moving around, asking questions. Once we've done that, we sort of have an idea of what usually isn't right. What isn't right typically comes down to 3 things: overutilization or underutilization of plants, so too many machines. If you take the Belgian setup we were running that quarry 2 million ton production with 26 machines as we acquired it. It's gone down to 13. We were running it with the equivalent amount of people, gone down by half as well, and that balloons your profitability. So that's the next 3 to 6 months of work, is to implement those things. And then typically what you end up with is a phase where you want to make changes, but these changes aren't easily done in a short time frame because they're contractual. They are customer relationships that need to be revised, or customers you want to just get, you can't supply anymore at that sort of price because it doesn't make any sense. You don't make any money on it. So then we go through a phase of that type. That's sort of the commercial aspect. And once that's done, we have usually sort of 20-30% more profitability out of the group. That's sort of usually what happens. And then after that, we started then bolted into the neighboring platform, the neighboring business, to get the synergy between cross-selling.
You make a good case that quarries are great businesses,
Yeah.
But surely the sellers also know that they have regional monopolies and things like that. How do you make sure you don't overpay for assets?
Yeah, good question. So strategy number 1, very simple. We are in every sort of jurisdiction here. There's always a deal to be done somewhere that is more interesting than the one that's too expensive. So that keeps a good discipline for us, right? It's just internal. So if you can buy something at 10 times earnings here and at 6 times earnings there, that's the one we're going to go for because it's cheaper. Secondly, specifically for private owners, we are quite a good home for their business. You think about someone that built a quarrying business for their entire life, doesn't really have succession to be able to deal with sort of the next generation, is either not interested or not there. They don't want to see their life's work destroyed. So they like the fact that we keep their people, keep the name. We are able to secure a lot more profitability out of these groups without actually firing half the staff. And so the 8 people that are in Belgium that aren't working on these machines anymore, they were redeployed in other parts. So that's a key point. We like to keep these businesses run fairly autonomously or in sort of smaller groups, which means that, again, the vendors see that their life's work is maintained. We always offer someone that sells a business if they want to continue and stay and work with us. Either if they are just, they've done it, and they don't want to do any day-to-day anymore as a non-executive sort of advisor, or if they really sort of say, well, you know what, I've got another 10 years, I'd like to do something. Well, stay with us and help us grow the business. Example, in the Chester-based businesses, CCP, the 2 founders, Jim and Paul, they only left the business January this year, 3 years after the acquisition, and they said, well, done my job now, thank you very much, I'd like to enjoy my retirement. So these are things that help convince a seller that they get good value for it, but they shouldn't try to sell it to someone else at a much higher price. So that's help.
Sorry, that's going to have to be the last question now.
Oh.
Obviously, you can take questions outside.
Sorry, no hand
What
first.
will cause you to step on the brake in terms of leverage and say target 1.5 rather than 2 for a period?
Significant slowdown across Europe in terms of the economy. That's it. The business, the covenants are such that we have another turn and a half above the 2. So there's quite a bit of flexibility there. Also, in quarrying businesses, you can reduce capex and operating spend quite aggressively, quite quickly. You can defer those things. So even if you have a slowdown in EBITDA, your cash generation is still pretty decent. And that means that the banks are usually fairly happy to continue to support a business like this. The 2 times number is a number we're comfortable with. That's the one? All right, thank you again.